Welcome to the Transfer Pricing Masterclass, the podcast where we discuss all things tax-related. Today we're going to dive into the complex world of transfer pricing and the arm's length principle. This episode is perfect for anyone who wants to understand this important concept and how it affects multinational companies. What is transfer pricing? Let's start with the basics. Transfer pricing refers to the pricing of goods, services, and intangibles between related parties, typically within a multinational corporation. These transactions can involve the transfer of intellectual property, raw materials, finished products, or even services like management or marketing. The primary concern with transfer pricing is that it can be manipulated to shift profits between jurisdictions with different tax rates, leading to tax avoidance. Segment 2, the arm's length principle. Now let's discuss the arm's length principle. The arm's length price is a critical aspect of transfer pricing because it aims to ensure that related parties deal with each other as if they were independent entities. This means that the price at which goods, services, or intangibles are transferred should be the same as the price they would have charged or paid if they were unrelated parties negotiating under similar conditions. Importance of arm's length pricing. So, why is the arm's length price important? Well, it helps tax authorities prevent the artificial shifting of profits through transfer pricing. By using the arm's length principle, tax authorities can compare the prices charged by related parties to those charged by unrelated parties in comparable transactions. If there is a significant deviation, tax authorities may adjust the taxable income of the parties involved to better reflect the arm's length price. Methods for determining arm's length price. To determine the arm's length price, tax authorities usually rely on several methods. Some of the commonly used methods include the comparable uncontrolled price (CUP) method. This method compares the price charged in a controlled transaction to the price charged in a comparable uncontrolled transaction. The resale price method. This method begins with the price at which a product is resold to an independent party and deducts a gross profit margin to arrive at the arm's length price. The cost-plus method. This method starts with the cost of producing the good or service and adds an appropriate gross profit margin. The transactional net margin method, TNMM. This method examines the net profit margin relative to an appropriate base, such as sales, assets, or costs, earned by a taxpayer in a controlled transaction. The profit split method. This method divides the combined profits between the related parties based on the relative value of their contributions to the transaction. Tax authorities may choose the method that provides the most reliable measure of the arm's length price, considering the specific facts and circumstances. Transfer pricing documentation. Multinational companies need to maintain transfer pricing documentation to demonstrate that their transactions are at arm's length. This documentation typically includes a functional analysis that identifies the functions performed, risks assumed, and assets employed by each party. Details of the method used to determine the arm's length price and the rationale for choosing that method. Comparable data, including information on external comparables or internal comparables, used to establish the arm's length price. By maintaining thorough documentation, companies can minimize the risk of transfer pricing adjustments and penalties. That's it for today's episode of Transfer Pricing Masterclass on the arm's length price. We hope you now have a better understanding of this essential concept and how it affects multinational corporations.